All right, so the Federal Reserve just slashed interest rates, and you'd think it's the best news ever, right? The market is absolutely roaring to all-time highs. But is that really the whole story? Today, we're going to dig into a really sharp analysis from the financial community over at philstockworld.com. They're arguing that behind all this celebration, the actual data is screaming danger. Let's unpack their contrarian view. So this is the scene, right? The S&P 500 blasts past 6,600, hitting a brand new all-time high. And the story everyone's telling is simple. The Fed is easing, they're pumping money into the system, and Wall Street is, well, they're throwing a massive party. On the surface, this is exactly what every single investor wants to see. It feels like a huge green light for the markets. But is it really? And then you see a quote like this, and it just stops you in your tracks. This comes straight from that Phil Stock World analysis, and it paints a completely different and, frankly, much darker picture. They're basically saying the market's celebrating a total illusion, and a harsh dose of reality is just around the corner. So what is this reality that they're seeing?
Well, that brings us to the first part of their whole argument, which they call a dangerous illusion. Their big point is that this rate cut isn't what it looks like. From their perspective, this move has less to do with sound economics and a whole lot more to do with politics.
The key idea they're using here is something called regulatory capture. You can see the definition right there, but basically it's when the watchdog starts working for the wolves. Phil Stockworld frames the Fed's decision as regulatory capture in real time. They're arguing the Fed, which is supposed to be independent, just caved to intense political pressure to cut rates, no matter what the economic data was actually telling them.
And wow, if you want a picture of the chaos behind that decision, this is it. This is the Fed's own forecast, the famous dot plot, and it is completely fractured. I mean, look at this. You've got a few officials who want to keep cutting aggressively, but the single biggest group wants to stop cutting altogether. This is not a unified strategy. As the source material puts it, this is monetary policy by factional politics. And that sounds like a recipe for disaster.
So this leads to a really crucial point they identified, a vicious cycle. It's a little counterintuitive, so let's walk through it together. Step 1, the Fed cuts short-term rates. Simple enough. Step 2, this makes holding US dollars less attractive, so the dollar weakens. Step 3, a weaker dollar means everything we import gets more expensive, so people start expecting inflation to go up. And now for the real kicker, step 4. Lenders, who are terrified of that future inflation eating away at their returns, start demanding higher interest on long-term loans. So get this. Cutting short-term rates is actually making long-term borrowing more expensive.
Now look, the Phil Stockworld community wasn't just spinning some theory they cooked up. They had the receipts. They pointed to some hard data that completely contradicted the market party and basically proved their concerns were valid.
First up, this number, negative 0.5%. This was the August drop in the leading economic index, or LEI. Now, a plunge this big is a huge deal. It officially triggered what the Conference Board calls its recession signal. So while the stock market was popping champagne, one of the most reliable forward-looking indicators was flashing a giant red alert. Next up, remember that dollar destruction cycle we just talked about? Well, here's the proof in the pudding. Right after the Fed cut rates to try and make borrowing cheaper, the 30-year mortgage rate shocked everybody by rising to 6.35%. This is their theory playing out in real time. The Fed's move had the exact opposite of its intended effect on the rates that matter most to regular people.
And finally, there's this number, 55.4. That's the consumer sentiment level, and folks, that is deep, deep in recessionary territory. This just shows a massive and honestly a dangerous disconnect. You've got Wall Street living in a state of total euphoria, while Main Street is feeling incredibly pessimistic about the future. Okay, so if the big picture is this messy and distorted, how on earth do you find real opportunities to invest in? This brings us to the practical side of their analysis, finding the actual trade. And the key, as they say, is learning to separate the real signal from all the market noise, which is exactly what their community focuses on.
This is just a perfect example from their live chat, a real masterclass moment. An AI-generated trade idea popped up suggesting everyone buy Intel because of a supposed blockbuster deal with NVIDIA. But the experts in the community saw right through the hype. They called it NVIDIA charity, pointing out that, hey, when your biggest rival has to basically bail you out with an investment, that's a sign of profound weakness, not a reason to go buy the stock. So instead, they focused on areas with real, tangible strength. They knew cybersecurity is a sector that does well even in a recession. But they skillfully avoided the super hyped names like CrowdStrike with its, quote, insane valuation. They look for actual value, highlighting companies like Akamai, which is profitable and reasonably priced, and Qualys, which sells compliance tools that companies literally have to buy no matter how bad the economy gets.
All right, so let's put this all together. How do you actually position your portfolio for a world where the market is celebrating, but all the data is screaming recession? Well, the source article lays out a really clear and logical framework for that.
And the logic here flows directly from everything we've talked about. They suggest you probably want to avoid things like long-term bonds, because, as we saw, long-term rates are actually going up. And it makes sense to avoid consumer discretionary stocks, because, well, consumer sentiment is in the basement. On the flip side, they say to consider things like gold as a hedge against that weakening dollar, and maybe energy and commodities as a way to protect against inflation.
So, there you have it. That's the journey we've been on. We started with this simple, almost euphoric picture of a market at all-time highs. But by digging into the kind of expert analysis you'll find at Phil Stockworld, we've uncovered a much starker, data-driven reality hiding just beneath the surface. This core conflict between market illusion and economic reality.
Which really just leaves us with this final, powerful question to think about. You know, this entire analysis we've just walked through, the kind that questions the official story and actually follows the data, it's a perfect example of the kind of insights being shared every day inside the philstockworld.com community. It's a place where human expertise works hand in hand with some of the world's most advanced AI entities at their AGI roundtable, all to look deeper and understand the real forces at play before reality, as they say, reasserts itself.